Hello, everyone. Welcome back to the Rational Investor School for Trader Development. Just moving my microphone around here. Now I'm nice and close. Hey, all you crazy kids out in DJ land. I'm just having fun. Let's see if everybody's awake. Wiki, wiki, eggs a bakey. Yeah, there we go. Hey, we're live on YouTube now. Everybody's awake. Wiki, wiki, eggs a bakey. Considering there's like over 100 people in this class, we've only got 8 people watching on YouTube right now. Oh boy, that's a little disappointing. But the feedback I'm getting is you guys seem to think that this is good value, and I know that there's a lot of people that are away and watch these classes at a later date, so all good. But anyway, welcome back to class. You think, have I got that very white voice? I can't go as deep as Thomas, though, man. When Thomas, he comes on, it's so cool from the UK. Thomas is awesome. But anyway, enough frivolity. Here we are back in the saddle. This is our level 2 program, our RITE program. And we're coming into the tail end of the program. Today, in fact, actually is our last sort of learning module. And then next class, we'll do a complete program review and then hand out the final exams. And let's see how you do on whether this delayed program in the way that we've done this. Because keep in mind, guys, we've been working together since last September. And it kind of sucks, but I have seen a few people that started out all gung-ho in September are kind of getting fatigued right now. But nonetheless, here we are working our way through our Trader Elite material. And this is class 11 and all about the Delacour index. And really what this is all about is working with and building algorithms. I do know we have a few students. Wow, you actually get a transcript? I wonder what YouTube's going to say when I go. I hope they spelled that correctly. Now, I'm sure the YouTube algorithms are just going out, what the hell did he just say? Anyway, you can see Brian's in a bit of a giddy mood this morning. So anyway, welcome back to class, everybody. Brian, try and stay on focus here. Hey, nice to see you, Sheila. Oh, my favorite girl. I miss Sheila so much. Sheila, we got to do RSP meetings here. We're coming into RSP season. Some of these little stocks that we bought last VCIM just took off. All the swear words are left out. That's adorable. Anyway, so if we zoom through our course curriculum, here we are on week 11, the Delacour index. And as always, of course, you guys, I like to make sure that things are consistent and reliable and you know what's coming up. And really the point of today is not necessarily to, for some of you, this might be completely brand new. I know others on the site like working with Alex's and Sen's and Benjamin scripts on the site. So you may have already been introduced to this, but really what I want to show you guys today is an algorithm that I built years ago. And I used to actually do this algorithm manually on paper. And I save everything. So, I mean, I can even go and show you the sheets from back in like the 80s and the 90s of me writing out these scores manually. Once we got onto sites like TradingView and they introduced the scripting languages like PineScript and stuff like that, we could actually start automating all of this. And this is just one example that I'm going to show you. I mean, there's a million different algorithms that you can build. You can build algos to do any number of different things, which we'll talk about shortly. And the great part about it is we have such a robust community and you guys are also tech savvy that it's actually really cool to watch all the various different machinations of these algorithms. And your sort of personal spin on the algos. And that's really what I want to get to you guys to the point is where you take my algo and I'll just sort of give you as sort of like a framework to work with. And then you start making it your own, and you start letting letting your sort of personal flair really show through on these things. But with that said, what we're basically going to be doing, of course, is as I said, I like nice and consistency. So gee whiz, here comes the PowerPoint slide presentations. And hopefully you took the opportunity over the past week or so just to take a look at the slideshow. So when we go through this, nothing's really sort of brand new. But if not, this is basically what we're going to be doing. TRI's Delacour Index, and that's the name that I gave my algo. I mean, you can name your algos anything you want, but Delacour just happens to be my middle name. And as I said, yeah, Oscar, I used to literally sit down on a daily basis and give the indicators that I like to use, MACD, RSI, Willie, moving averages, OBV, money flow, just literally give them a score of, are you bullish, are you neutral, are you bearish, and literally used to write those numbers out by hand to come up with my index score for the assets. So if anything, that in itself is a good analogy that you can build algos and they can completely be manually generated. And of course, they're just as valuable as if the computer came up with the scores. And it also goes to show, I mean, I was joking with one guy on Twitter this morning. He was trying to send me a tip on the Lightning Network through Twitter or whatever. And he's like, well, Brian, you don't even have this tip bot set up. What the hell? And I'm like, dude, I'm the guy who used to get my charts in the mail. So, you got to remember, I'm still very a paper world kind of guy, which I have really amusing. But anyway, okay, so let's get to work. What are we going to be covering today? Yeah, well, the irony of it all, Oscar, is I remember distinctly the days when the Commodore 64 was sort of like cutting edge. And that was a big upgrade. We used to use, they were like, I think it was an Apple IIc or something along those lines. And then when Commodore 64 came out with the tape cassettes, that was like, oh, that was like high tech. And actually, I think Apple IIc came in after that, but nonetheless. Okay, so what are we going to be doing today? First off, we probably just want to give sort of a nice simple definition of what the heck an algo is. And the interesting thing is that most people don't realize that you can build algos to do anything. Probably the most important thing about algos is the fact that they are written by human beings. I know a lot of people get really angry at things like high frequency trading and bots and stuff in the market, but you got to understand that they're all written by humans. So it's not really like the computers take over. The computers just do what the humans tell them to do. And let's hope it stays that way, because as soon as we get to the stage where the computers actually start thinking for themselves is probably the day that human species is deemed redundant and we are politely removed from this world. But anyway, that's another conversation for another day. So we'll spend just a few minutes talking a little bit about what algos are and how they're built and who uses them. And then, really the most important part of today is to introduce you to the algo that I built, the Delacour Index. And I would like to give everybody a copy of this script, and just, you make sure that you have the script in your database, in your folders, whatever. And you understand the basic mechanics of how Pine scripting works. We'll talk a little bit about what the index actually includes and why I like to sort of balance it between both. And really, we should probably here just put price momentum and volume momentum studies. And the point of, as we sort of learned in the level 1 program, we can use indicators to help us understand price momentum. We can use indicators to also understand volume momentum. And, there's a whole field of technical analysis that I really haven't talked to you guys too much about in this education program. And I've been kind of on my butt a little bit about it, not getting off my butt and getting it done. But we could also technically include volatility momentum studies. But I'm not going to include that in this conversation today. Primarily, the Delacour index is built around price and volume momentum studies. So that's what we're going to be concentrating on here today. And by all means, if you get in there and you're playing with the script and you're building it out, could you use volatility momentum studies? Sure. As I said before, what I really want to do is just give you sort of the framework and then just give you the opportunity to dig into the script and have fun with it. And then I'm going to talk to you a little bit about how I use this indicator, this algo to generate signals, both the idea of cumulative signals as well as using multiple time frames in conjunction. And then finally, we'll just leave off with just sort of an example of how I would use this in the trade process. And actually, I don't have it actually running taking trades, but for the purposes of today's class, I fired up the DI and plotted a bunch of the recent signals, and you can just see how algos sort of operate generating signals in the market. So without further ado, let's get to work. Actually, I'll take a sip of beverage first. Okay, so what the heck is an algo? Obviously, we're here to try and make capital gains on purpose on assets that we're trading in the marketplace, and really, our conversations in the level 1 program, we're trying to get you to move away from this sort of random walk kind of thesis that has dominated the marketplace. And random walk is really sort of it's a convenient way to remove sort of the onus of being able to predict price movement and direction by the sort of, the ivory tower class. Well, don't try and time the market because you can't do it. It's completely random. So they just simply make that blank statement and leave it at that. That's the end of the conversation. Hopefully what you've learned here through this so far, the level 1 and this level 2 program, is the market is hardly random. And if we can identify whether it be location, whether it be indicator signals, whether it be structure, if we can identify repeatable patterns in the marketplace, that gives us, quote unquote, an edge where we can basically change that thinking from random walk, just a flip of the coin, to actually there's a statistical percentage that suggests that you are going to be right versus being wrong. What is known as an edge. And what I don't like to start the education process for new people to trading by talking algos. What I would prefer is that you actually go through the process of understanding very, matter of fact, what a good trade actually looks like and what goes into manufacturing a good trade versus a crappy trade. And that's all about identifying tools that can give us that edge and tilt the odds in our favor. And I think it's in your best interest when you're first starting out to go through the very long, arduous process of manually understanding these concepts of location, indicator confirmation, and structure. Once we do have that edge, and we see that, things like reload zones, the odds of the market testing a low and holding that low of the range and then turning around and revisiting the upper end of the range are actually higher than just expecting a push to new lows or highs. We know from the level 1 program, of course, that markets like to range 70 to 80% of the time. So in essence, building trading plans that have force you to be a buyer against bottom ends or ranges and a seller against top end ranges, hopefully you can understand that that very simple principle is giving you a 70 to 80% edge. And you could very easily build an algo that just simply identifies when we are at bottom ends of ranges or top ends of ranges and just automatically takes the trade at those levels. That's a very simplistic approach, but nonetheless, ironically enough, in trading, sometimes the simpler the better. The point here is that we just simply need to identify that edge. And then we, as professional market participants, we're not in the business of predicting markets. That's stupid. And as I sort of highlighted in recent sort of public videos, quite often your opinion actually gets you taking the wrong trade. And what ends up happening in trading a lot is that the easy trade, the trade to follow the crowd, to do what is popular, it's going to get you lots of likes on Twitter and stuff like that, is usually the wrong trade. And ironically enough, my old boss, John Hoagland, used to always say, the harder trade, the trade that's harder to take, is usually the righter trade in the end. But the point here is that we just need to figure out what our edge is. And then we, as professional market participants, we just go in and we just hunt our edge. Put your opinion away, just trade your edge. And it's just simply a question of rinse and repeat. Just keep doing the same damn thing over and over and over. And ironically enough, and it's probably why computers do so well at this, is that if we actually construct our trading plan correctly, it's going to have us doing the exact opposite of what the public sort of is thinking. So you're not going to make a lot of friends on things like social media, taking those edges. And ironically enough, a really well-designed and well-executed trading plan is actually kind of boring. Because in essence, what we're doing is we're just in the market hunting our edge, trying to make a profit from our trading, and put your opinions away. Opinions are worthless, and you guys all know that, right? So hopefully you've just heard the message that we want to identify our edge, we want to execute our edge, and we just simply want to rinse and repeat. And quite often that process is actually kind of boring. And as a result, computers that basically do what they're told to do and can't inject an opinion into that matrix, they don't care. It's not like they're going to be personally offended or not. They just do what they're told to do. It's probably worth taking a moment here. Algo, you probably heard that term. What is algo? And it's just simply for short form for the word algorithm. And if you need to Google the word algorithm, in essence, it's just simply a script, for that matter, of instructions that are preset conditions that are met. And in essence, the algorithm is just, and really probably the easiest way for you to think about this is it's most of the time it's what they call Boolean logic. And Boolean logic just is that simple, if this, then do that, else don't do anything at all, if then else. And if you need to write down Boolean logic, that's basically how this process works. And of course, computers love Boolean logic. It's nice and simple. It's easy to execute. If this happens, do that. Otherwise, don't do anything. Now, the interesting thing about this is that, most of the people, and what we're probably going to focus most on here at TRI, and in this particular module, most people approach algorithms from a sort of technical analysis perspective. If a moving average is crossed, then do something. If it isn't crossed, don't do anything. If an indicator is overbought, then do something. If not, then it's oversold. Don't do anything or whatever. But we need to understand that algorithms can be constructed to act off of various different criteria. And what I see actually quite a bit is, before we get into that, let's talk a little bit about sort of fundamental algorithms. I know lots of people that simply trade the stock market based on what the direction and the trend of U.S. Federal Reserve policy is and short-term interest rate trends. Lots of other people trade. I used to know guys that used to trade crude based purely on the weekly inventory data that was produced by the American Petroleum Institute, the API. Employment information is often a huge algorithmic driver for trading, and things like GDP, or gross domestic product numbers. So we can build algorithms to take actions based purely off of fundamental criteria, as well as technical criteria, moving averages, indicators, levels, whatever. An interesting variant into the analysis process really is developed over, let's say, and I've been at this game so long. What decade is it? We're still in the teens, aren't we? So we'll say a good, 20, 30 years ago, was this field called quantitative analysis. Or you probably heard of the quants, QUANTS. And their algorithms and their thinking are driven off of things like social media. There's lots of people that follow the number of Google searches for things like Bitcoin. And you can build algorithms based purely on the amount of social or human interest in a particular name or asset. In crypto, that's very popular. And actually, it's interesting because crypto, of course, appeals to this sort of IT side of our society. So these social algorithms within crypto are extremely popular. So the point that I'm trying to make here is that we can build algorithms off of many, many different criteria. Really, the sky's the limit. And really, it's a function of that Boolean logic. If this, then that, else don't do anything at all. If GDP is up, then buy the stock market. If GDP is not up or else, don't buy the stock market. If Google searches on Bitcoin are trending, then buy Bitcoin. If they're trending up, that is. If they're trending down, then sell Bitcoins. And then, of course, like what we're going to cover mostly today, if price crosses a moving average, if one moving average crosses another moving average, if, Willie is stupidly overbought, then we can spit up a score for these technical readings and then base your actions off of scores of multiple indicators. And I like to do that. Good old Brian never likes to take a trade just off of one reason. And this is one good thing about the DI, is that technically it's 45 different reasons all smushed together to give us sort of an overall reading of the health or ill health of the market. I think we probably need to understand that as well, algorithms can operate off of various different time frames. As I said, just a few minutes ago about people that trade off of GDP datas or Fed interest rate policies. Well, they might not be actually doing anything less than, say, a monthly basis, or even maybe even quarterly basis. I used to know guys that used to trade the Dow off of quarterly prints. I mean, talk about boring. They only have a signal January 1st, April 1st, July 1st, and October 1st. And other than that, they're not doing anything in the market at all. So, and then, of course, on the flip side of that, you have, we call them high frequency traders. Various students over the course of TRI's history have built lots of different algorithms that I had one student who used to literally trade the DOM based off of algorithmic information, and the way the order book was looked, and counting trade sizes and bids and offers. And of course, he was operating off of like 5-minute and 1-minute and even tick basis. I'm not going to get into trading the DOM with you guys here in level 2. I do get into that in the level 3 program, because that's pretty tricky stuff. And unfortunately, it's a whole conversation unto itself. And really, really great information. That's extremely powerful, but it's extremely advanced. And, the sad part about trading with the DOM is most new people to trading actually start by watching the DOM, and the DOM usually gives you completely counterintuitive information. So, you'll look at the DOM as a noob and think, oh, this thing's moving up, I got to buy it. What you don't understand is actually that's exactly what they want you thinking. And ironically enough, they're actually setting up a downside move. So, like I said, I'm not going to get into the DOM today, but the point of the matter here is that algorithms can operate off of many, many different time frames. And as I had started off this conversation with, it's important to remember that these algos are written by human beings, and they're only as good as the human being programmers that write them. I remember one guy in crypto wrote an algo about 3 or 4 years ago, and a new coin was listed. It was one of the Z coins, and his algo went absolutely nuts. And he ended up buying this silly coin at something like 3,000 Bitcoins for one damn coin of this thing. And I think the algo basically destroyed him. So, at the end of the day, we have to understand that these algos are only as good as their computer programmers. Algos also, too, have taken on a very different sort of role. Was it Zcash? Yeah, Dan seems to remember that. In that we can find, and you can see evidence of algos in the marketplace. When I used to be a prop crude trader, and we'd start coming into specific levels, things like Mountain Man 78.6, you could literally watch the algos come alive, and you could actually start watching the algos start to fight with each other as we come into those levels. But also, too, I want you thinking about things like derivatives. And, of course, this is another sort of level 3 conversation where, you can have algos crunch, massive amounts of data. And when we get into things like derivatives trading, there's a whole bunch of variables that go into pricing derivatives much, much faster than human beings can. And so as a result, and I don't know whether I ever told you the story. There's a great story of a guy back in I think it was actually the early 80s, that they actually wanted to try and prevent this whole concept of algos sort of taking over the stock market. And they used to actually require that all orders that went into the stock market back in the early 80s, when computers really weren't that savvy, where they actually made a rule that all orders had to be inputted on a keyboard. And so one smart guy who had built his algo to trade options and identify when options pricings were out of whack with their Black-Scholes model, he actually built a keyboard sort of setup that had little pistons over top of every single key on his keyboard. And then when the algo actually said, okay, this asset is mispriced, go in and sell it or go in and buy it, the algo would send instructions to the keyboard with all the pistons on it. And the regulators came into the office one day to audit this firm, and all of them just hit the deck, all the regulators, because all of a sudden, just out of nowhere, the algo had a signal and it sent instructions to these pistons on the keyboard to enter in the order, and it sounded like a machine gun going off. And the regulators were, what the hell was that? And he said, well, you said, according to the rules, that every order had to be entered in onto a keyboard, and so this was our solution for that problem. Which, of course, pissed the regulators off to no end, because technically they didn't break the rules, but they still had the algos entering the orders. So, I mean, the irony. Oh, there you go. James has got a fun little image for everybody to check out there in the lounge. We gotta scroll up though. That's gonna distract the hell out of me. I should find that video though for you. The guy's like super ridiculous rich. Oh, thanks, sir. I didn't mean to do that. But anyway, it's all good, guys. It's all good. So we have to understand that algos, they can think and operate a lot faster than us human beings. And so as a result, it shouldn't really surprise us that they are taking over, because they can react much, much faster than we can. In fact, actually, even some of these high frequency trading algorithms that just simply need to get their order, they need to be on the front of the order book. Remember, I told you about the gentleman who built the algo to trade the DOM. They actually would relocate their offices as close to the data centers as possible so that they could get their order in faster than the competition. And of course, we're talking like, nanoseconds, just incredibly fractional time periods that us humans, we just simply can't operate in. But I think what, it all comes down to, number one, every single algo that operates in the market is basically everything that we teach in this course. We can actually take everything that you've learned in this course and algorithmize it. It's just really a question of just building scripts. And, every algo, ironically enough, the irony of it all is that every single algo that's built has a trading plan, Boolean logic, if this, then that, else don't do nothing. And so really the irony of it all is all an algo is doing is just exercising a trading plan. And of course, if the algo is built correctly, then really they actually should basically just be doing the TRI course material. And in a weird sort of way, like when I used to do public presentations of the bot, the sort of caption that I had underneath the title of the bot was, when I turn myself into a robot, I trade like a machine. So the irony of it all is it's not really like they're reinventing the wheel. Everything that you've been taught and you learn through this course, it can be algorithmized, and you can build bots to trade them if you want. And remember, the bottom line here is whatever the algo was built, it's doing is it's just hunting for its edge and then just simply executing on that. And the good part about this, of course, is that computers are unable to have emotional responses. So, I even saw in the lounge this morning, in just the TRI lounge, new people were like, oh my God, I can feel FOMO coming in here. I so want to chase this thing, as of course, Bitcoin's running up in price. And we're all sitting there going, okay, now just cool down, slow down, go take a cold shower, right? You missed this setup. You have to wait for the next one. A computer isn't suspect to that, subject to that. Okay, so hopefully we've given you just a nice simple overview of what algos are. And really, I don't think that should be rocket science to anybody. It should just be simple review. I do like this screenshot here I've included. It's just such a really simple working example. And this is just a relationship of moving averages algo. So you can see we have different moving averages on the screen. And we have 3 different scoring methods based on what the moving averages are doing in relation to each other. And as the moving averages cross, you can see that the algo scores are changing as the readings change. And really all it is just relationships. So hopefully you can see as we crossed up here, one of these signaling systems went from bearish to bullish. And then, unfortunately, I don't think I have the third one on here, which is a bit silly. But in essence, I follow 3 different moving average relationships on these, and that's what these 3 different colors are here. You can only see 2 on here right now. Sorry, guys. And then based on the fact that we have 3 different inputs, red, blue, and white, then that means that we can simply add those scores together to create an index. And then quite literally, you can see that the index itself of just these moving average crosses oscillates from extremely bullish, market is up, to unwinding, market rolls over, M top, starts breaking down, moving averages cross. And you can see how the index shifts to bearish. And then as price tries to perk up, you can see it comes back to the midpoint, but just can't get through there. And we just keep working our way lower. So, ideal, and really you could build a algo just off of one simple indicator relationship. This happens to be moving averages. And I would recommend that you use multiple indicators in your scripts. But this hopefully is just a nice simple visual of how this works. I'm just going to simply plot my moving averages on one pane. I'm going to tell the script to give a score given the different if, then, else relationships. And then I'm just going to simply accumulate the score into an index. And then ultimately, if you want, you can create indexes off of a whole bunch of different indicators and then smush all those index scores into one ultimate score for your indicator. Okay, let's move on to the next slide. So I don't know whether I was recording this or not, but I've been doing the Delacour index for easily 20, 30 years. Well, let's say 20 years, right? So 1999, I can visualize in my head, and I could probably find the charts in my files because I keep everything. Where I used to literally plot out the scores of these indicator readings at the very bottom of the chart on a daily basis, and then just simply come up with a cumulative score. So as this sort of says, it's really the end result of more than about 25 years working within the trading industry, trading stocks, commodities, options. This is, in essence, this is probably a really good sort of proxy for my education process going through learning how to be a trader. So in a weird sort of way, it's hopefully what I'll do here with this Delacour index is I'm going to basically be distilling 20, 30 years market experience into one very simple tool to help us sort of understand technically the health of the market. Each indicator that I use, and of course its particular settings, has a story unto itself. And like Brian's a weirdo. Have any of you, and how many people are actually watching? I got 20 people there. Have any of you ever heard of anybody else in the marketplace using the 13-period exponential moving average? I doubt it. I'm the only person who's ever run into that. And it's funny, whenever you talk to people about using the number 13, It's almost like they don't like it. It's like it's kryptonite. So no doubt about it, the DI and its construction is very much a product of my career. And it definitely has my personal touch on it. If I saw somebody using the DI out in the public, I would definitely know that they had to learn it from me. Well, and I might argue that 13 actually is probably good luck, not bad luck. But you're from Transylvania. How's Transylvanian real estate doing these days? Is it on the uptick or the downtick? Because I totally want to buy a Vlad pad. Mind you, I don't think I'm going to be impaling people, but that's another conversation for another day. Okay, so the point of the matter here is that this is really the ultimate expression of my personal experience in the marketplace. No doubt about it. You know, I like to use crazy indicators like that heavily modified Williams percentage R. You're probably not going to find many people who use that either. Now, the indicator itself is plotted off of various different time frames simultaneously. And I think it's important for you to understand that you're going to get the absolute best performance out of your algos if you can intermingle multiple time frames into your analysis. So the DI itself is a reading of 15 different technical indicators on each time frame that's analyzed. The cumulative DI, which we haven't been able to really promote on the site too much recently, but I will show you slides later on of us when we used to operate it on the old WordPress site. It is basically a combination of 3 different time frames to give us that overall picture of the technical health or ill health of an asset. As well, and it's important for me because I've talked to you guys a little bit about that at the beginning of this conversation. I weight the index equally between volume and price analysis. In essence, there's 3 different studies of each perspective. So and really, you know, as I had sort of changed when I did the title, we could actually really make this between volume and price momentum analysis. I could very easily change the weighting of the various components in the indicator, but I like the way that it's working right now. And it produces the results that I'm looking for. But that doesn't mean you can't overweight volume studies. There's nothing wrong with that at all. Actually, I'm feeling a little bit warm. I'm going to take my sweater off. Hold on a second. But I'm going to leave my pants on. But no, I don't have any shoes on, so I'm not going to be trading per the Wookiees rules. And I'm just being silly. All right. So just be aware that when we look at the index itself, you're gonna the index itself is completely equally weighted between price and volume analysis. And the bottom line here is what I really want is I want a complete overall view of the technical health of an asset. That's really what I'm going for here, is that cumulative simple reading that tells me whether something is technically strong, technically weak, and then of course more importantly, do we have signs of reversals at extremes? In essence, signals themselves are generated using moving averages. And I have both a fast interpretation, which would be sort of like a fast moving average with the index relationship, but I also have a slow signal, and I'm going to be showing you in the way this algo is built today to show you it is based off of those slower signals. And that would be the relationship between the fast moving average and the slow moving average. All right, so hopefully that gives you sort of a backdrop of what the DI is and how I created it, why I created it, and what it sort of looks like. So specifically, this is basically what the DI is all about. I have, geez, I missed this word price everywhere. Price momentum, and then volume momentum. In the index. The price momentum studies that I use in this particular index are various different moving average relationships. And of course, you remember from our moving average conversation. Big fan of 13 EMA, 30 SMA, 200 SMA. I also have in the 6 EMA, which is a really fast signaling, but it's not, I don't think I actually have it built into this DI here in particular. We can always add it. It's not really that big of a deal, but I just want you to understand what the moving average relationships are. I use, of course, the modified Williams percentage R, or the Willy, to both give me ideas of trend direction, and more importantly, is the market overbought or oversold? And so, you know, we could have a very bullish reading out of the moving averages. You know, 6 is higher than 13, 13 is higher than 30, 30 is higher than 200, which would give you an extremely strong technical score. But if my overbought, oversold indicator is giving us an overbought reading, then that score actually gets reduced. So I would highly encourage you that if you are going to build algos like this, that you include a tool that gives you the ability to sort of back off your enthusiasm if the market appears overbought or oversold, or if it's oversold, to increase your enthusiasm. And then finally, really big fan, of course, of the MACD oscillator. So not only the moving average relationships in the oscillator, but also the histogram. Is it above 0? Is it below 0? We get a whole bunch of readings out of that. So we got like moving averages, we have our raw overbought oversold indicator, and we have our raw momentum indicator through the application of the MACD study. Volume studies, I like to follow sort of the net volume flow. In essence, we measure that, and you remember from level 1, the on-balance volume study. Is it above the moving average? Is it below the moving average? Is it above 0? Is it below 0? Can give us a lot of powerful information about the technical trend of volume. As well, I'm a really big fan of the money flow. So you know, money flow index is calculated slightly different. It's like an RSI of the volume combined. So it gives me just a little different perspective on volume. And then finally, I'm a big fan of just a simple accumulation distribution, or what they call the AD line. And of course, the AD line can give you really just simple, clear message about whether an asset is being accumulated or distributed. So when we look at the study in particular, what you'll see, and you remember from this slide, what we want to do is we want to create the study. Then we want to create a scoring system for the various different components of the study. And then out of the scoring system, we want to create an index that gives us an overall reading of either bullish or bearish. So if we look at this screen, and I know it might be a little difficult for you to see it all here, and if somebody needs this copy of this screen, then by all means, I think I still have this line around somewhere, but you can actually manually build this really easily. But as you can see, we have the OBV indicator. And is it above or below zero? Is it above or below the moving average? And so we have two different scoring systems there. And also overlaid on this, we also have the net index score. Here is the money flow index, exact same thing, just a little different perspective. Again, the scoring system, in the red and the blue and the white, and then the index reading overlaid in the background in gray. Here is the accumulation distribution study. Again, just a simple question. I've got two different moving averages on here. So not only are we studying the AD line itself, but the AD line relative to different moving averages. And hopefully you can see in this pane, we have yellow, white, red, and blue with all the various different scoring mechanisms. And then in behind, hopefully you can see in gray, I think that's gray, but the actual index of the AD line study. And then the price momentum indicators, MACD, along with the MACD scoring system. Willie, along with the scoring system. Does everybody see the general direction that I'm going here? Do you see the reoccurring theme of the way this works? And then finally, the moving averages that I was talking about earlier, fast moving average, medium-term moving average, slow moving average. They're different scores, right? Red, blue, white, and then the index reading of those relationships in gray in the background. That make sense? Everybody understand the basic Boolean logic behind building this tool? Can I get some feedback here, people? Anybody like, what the hell is that screen? And actually, I think I even, for fun, I loaded up, here are all the different indicators. So here we have OBV, right? I think MFI, the AD line. Mind you, I get the feeling those are backwards. MACD, Willie, and the moving average relationships. And really, this should just be common sense, guys. Right? This should be extremely Boolean logic, and especially, like for some of us that aren't super computer oriented, I can understand this might be a bit overwhelming. But for most of you that come from an IT background and computers are relatively simple for you to use, this should be fairly straightforward. Okay, so at this point, what I think I want to do with you guys, okay, so let's talk a little bit about signaling systems. So, all of these index readings, and you can see each one has an ultimate score at the end of the reporting period here. All of these index scores are all added together. And then I apply moving averages to that score. So what does that look like? Well, it kind of looks something along these lines. Like I said, TradingView has a very difficult time plotting these different scores cumulatively. Now, PineScript might have changed, and if I'm not mistaken, Sen has actually built a updated version of the cumulative indicator reading. And he does give that script out, but you have to ask him, and then he'll come back and he'll confirm that you're in this level 2 program, and he'll share that script with you. So just be aware of that, Sen has actually built the cumulative reading. I've never been able to get the cumulative reading going, but PineScript has changed quite a bit, and I haven't really looked at this in earnest, like you can see, which is kind of funny. This is when I first built this module for this course, and hopefully you can see, what the fuck is BTCE? Hey, look at that. So James, you superstar. So James has got the link to Magpie's scripting language and his page on TradingView. So I would imagine that he has it somewhere in here. And really, it's just a question of just finding it, and if he he'll just and I don't know where it would be in here. Scripts, maybe. Delacour index. Oh, even better. Geez, you're an all-star today. All right. So in essence, Sen has built this script, as James has just showed you here, to help you. Now, to be perfectly honest with you guys, I don't want you to just blindly just, go and grab this script and that's the end of it. That's not the purpose of today. Now, like I said, Sen has built this. It is there. If you want to reach out to him to ask him for this, his script, that's fine. I'm more than happy to endorse you using it. But I would actually prefer that everybody here get your hands nice and dirty and let's go in and build these scripts ourselves. So what the heck do I mean by that? But before I do that, let's just talk a little bit about these different signaling systems. So, here is that Delacour index reading. And I remember we had the last screen was all of the various different components, all spitting up an index score at the end of the reporting period. And this screen just shows you, based on whatever time frame you were working off of, that actual indicator score. And it has like a maximum reading of like 60 and a minimum reading of 0. As well, part of the indicator scoring systems is I've overlaid moving averages. And in essence, you can see here is a situation where the index itself crossed the fast moving average. But you can see that the moving averages themselves actually started to cross and recross here. And the signaling system for your guys is the default that I'm going to give you guys. It's set to the moving averages crossing here. And so you can see this happens to be off of a 4-hour chart. This pane happens to be off the 2-hour chart. And again, there is the index reading and there are the moving average readings. And you can see the scoring system, buy or sell, will spit up a signal when the moving averages cross. So you can see it cross bearish. The bulls in green here go to 0. The red bears go to 1. So we get a crossover signal. And then conversely, when the moving averages cross back bullish, the bears go from 1 back down to 0, and the bulls go from 0 up to 1. So that's how the individual time frame signals are generated. And as I had said earlier, off our old WordPress site, and Stuart even built this. He has it lying around. He's so overwhelmed with work that he just hasn't gotten back to this. But in essence, this is the cumulative, all 3 of these time frames all smushed together to give us an overall reading of the technical health or ill health of the asset. And hopefully you can see, reading 75, obviously, just like RSI studies, that's, getting overbought. You can see the moving average crosses here, which basically painted a weaker market. You can see the moving average cross here painted a stronger market, and vice versa, just as we go through the cycles of the market. The cumulative readings giving you buy and sell signals as we go along. As you can see here, nice little turn in the market. And if we zoom in on that, in essence, you can see the fast moving average and the index itself all starting to turn bullish. And our sort of trade signal is generated when the fast moving average crosses over the slower moving average, or right there. And that's basically right on that event, producing that little rally there. And you can see the index starts to fail and break down, in essence saying that that little signal is done. Now, there's 2 different ways to use the DI. Like I said, TradingView has a very hard time importing high and low data from different time frames on sort of their cumulative script writing. They may have updated the script, and it might have gotten a little bit easier and better to do these cumulative signals. So if anything, I kind of want to leave that in your part to play with over the next week or two and see if you can get TradingView to create cumulative, what I call DI signals. I would imagine that most of you are going to be in sort of this camp where we can plot the DI off of, and I would recommend doing 3 time frames. I suppose you could do 4, 5, 6, 7, 8, whatever, to get the signal more and more and more refined. But in essence, this is just a simple example of using 3 time frames and what I like to call the, in this case, 4 thumbs, because I was using both all 3 of these, and then I wanted the cumulative also to agree with that. But in essence, if you just have these 3 signals, in essence, I like to call it the 3 thumbs, and I'll show you signals in a few minutes, just recently generated off of this. But in essence, here's just a really good sort of visual, off of the higher time frame, which happens to be this 4-hour. We can, at this point, start hunting long signals. So that's right down in here. Then off of that reversal, you'll notice that this, in this case, it was a 2-hour signal. Whoops, darn. 2-hour signal was generated a little bit later, came in sort of through here. And then finally, your 1-hour signal, in this particular case, the 1-hour signal was generated in here. So when we have all thumbs pointing the same direction, we usually have a very powerful signal that the market's going to move one direction or the other. In this case, everything's pointing up, and so as a result, what a shock, the market rallies. And this is how I'd ideally like for you guys to start out using this, is just to simply, load up your algo. And if you want to start with my settings, great, fine. And then just start hunting off of multiple time frames. And when all the signals are aligned and they're all pointing the same direction, you got yourself a trade idea. I think actually, why don't we get into some sort of, well, actually, you know what I want to do now is let's take the time now and give you the script. This is actually how I'd like to, would be better if you could make full screen. Yeah, I know, but I'm a pain in the butt. I do like to have your text here. And really, what I'm talking about is not really that relevant right now. What I want you to do is I want you to get in here and start using this, and then you'll understand this completely. So there's 2 different versions. They're basically the same script, but what you have to understand with Pine script, and maybe, for your sake, Nacho Don will maximize this. I've created 2 different versions, 1.11 and 1.21. They're basically exactly the same script, but different things are plotted on the script. So let's first start with sharing the actual script with you, right? So it's a DI 1.1. My suggestion to you is I'm just going to cut and paste this. Probably the easiest way to do it. You can see this particular script's only 160 lines. It's not that much code. I'm going to copy that, and then let's maybe dump this into a notepad document. Right, and we will say save as, and we'll call this DI 1.11. I think that's what I called it. Yeah. We'll save that. Okay, that looks fine. Then we will, I don't know whether I can drag and drop, but let's see what happens. We will pin a message. No, that's not what I want. I want to maybe, how do I go file, upload, file list? Yeah. Nope, that's not going to work. All right, how the heck do I do this? Welcome to computer programming. Crazy. do I upload a file? Maybe I just, maybe it's just off of one of these buttons. What happens if I just dump that in there? Maybe it'll work. I just dump that in there? Nope, that's not going to work. Oh, wow, my whole screen just disappeared. That's interesting. Not quite sure what I did there. Sorry, guys. The whole screen just disappeared. Well, that wasn't quite what I was expecting. So let's keep forging forward here. All right, so at least we got the screen back. That's what we're recording. Okay, good. How am I going to do this? I thought this would work. Maybe, you know what? I think I might even have it in the library. Let's go take a look over there and see what's going on. Library. Trading view scripts. I don't have it in here. Fudge. Okay, how am I going to do this? I've got the saved. How do I upload it to Rocket Chat? What am I doing wrong here, James? I'm doing something wrong. Actually, you know what I'm going to do? Why don't we? Oh, but I haven't done that yet. Darn. Oh, what a silly boy. All right, well, we'll figure this out. That's not an alternative. Computer icon. Okay, it is a computer. But I see camera. Oh, maybe that's what this button is. Hey, there we go. You're so smart. Thank you, whoever said that. All right, so DI. So this is DI script signal. DI script. I'll go. All right, so let's end that. Oh, you're so smart, Joji. All right, so everybody, go and grab that document, please. And we'll even pin that to the room, so that way. There's a little pin button. Is that what this does? Nope. How do you? I'm so silly. And it's funny. I think I was joking with you guys earlier. Some guy this morning was teasing me on Twitter. There we go. Pin message. All right. Awesome. Okay. So the DI script has now been pinned to the room. And now what we're going to do is we're going to now use the signaling. Well, not use, but give you the signaling script. We'll go study and yeah, we'll go like that and go like that and go like that and go select all and paste, save as. And this was 1.21. Okay, that should work. All right, and then computer icon. What a silly boy. Couldn't even see that. What a knucklehead. All right, and then we'll go DI script signals. Oh, now we're rocking and rolling. Thank you, Joji. I appreciate your heads up there. And we will pin that. Boom. All right, so everybody, your assignment, and actually there's only about 20 of you on the class page right now. Please go and grab that script and add it to, I know where the hell is this? I think it's that page over there. Yeah, there we go. Yeah, there's 20 of you on there. So do me a favor if you could. Go and grab both versions, copy, you know, and how do you do this in PineScript? So maybe we should just go through that exercise. So if I'm going to do a brand new chart, we'll go new chart. There's my brand new chart. Bitcoin's going to the moon. Moon. What? I'm going to go down to the bottom of the page. I'm going to, and once you are done, Zbanji, can you post your chart showing me that you have both the script and the signaling script on your chart to show me that you have it. Okay, so that's the second part of it. But those people that are like, oh my God, how the hell do I do that? Let's go through that. All right. So we're going to load up, and it doesn't really matter what asset you're interested in. Doesn't matter. We're going to click down on Pine Script here, Pine Editor. You see where it says Pine Editor at the bottom. So click on that. And you'll notice it'll just be just a blank, and then this will be sort of like your very generic default setting. And really, we're going to just get rid of all that. Then you're going to go to the document that I just gave you, right? This is the DI 1.1. Let's load up the DI 1.1 and give you that one first. So I've got my 1.1 that Brian just shared with me. I'm going to simply right click and just go select all, right? And then go copy. And then come over to the Pine editor and just press paste. Boom. It is now done. All right, so there it all is pasted in. We're going to click save because we want to save this. And it might ask you, what name do you want to save it as? Yeah, see? So I'm going to say, where are we here? Q2 18 Q2? Is that what it was? No, I think it was Q4, wasn't it? Q4 18, because that's your class, right? DI index 1.11. Right? Click save, and hopefully you see that the title here now changes. And then I'm just going to click add to chart. Boom. Now, if the algo and the script is written wrong, then it will spit up an error message at the bottom of your page telling you what you've done wrong. And very simply put, you saw how I just did that. So there's no reason you guys can't both add this to your library. It's now in my library, right? If I click open, you can see all the different scripts that I have in my library. I got tons of them. But in essence, that is now in my library. Right, and what do we call this? You can even search for it. Q4, it might not even be in here. There it is, Q4 18.DI index 1.1. So I just went through that walkthrough. Everybody should be able to do this. If you have an error when you go to save the chart or add the chart to your chart, add the study to your chart, then it means that you've cut and pasted this wrong. I've just given you the script and I walked you through, so nobody should have a problem with that. If you do, then it means you got to go back and you got to do it all over again from the beginning to make sure that you've done it right. An excellent job. You guys are popping these on here like all stars. Okay, so that's step one, is we want to add the actual algo to your screen. Step two is we want to, and we'll just do this for you guys nice and simply. We're going to go new, right? Blank indicator script. As we said, we're just going to wipe this out. It's irrelevant. And then we're going to go in and we're going to load up the version 2, which is the signals, right? Same thing, load up that file. Just right click, select all, then that way you don't have to worry about whether you've cut and pasted everything. Go copy, pop into your script, paste. We'll save it. Remember we had a fun name there for it. We called it Q418 DI index. Click save. All right, it's now in my library. And then add to chart. And voila! You now have yourself the Delacour index and the scoring system rock and roll. Now, why are these different? They're technically exactly the same script. Excellent job, everybody. See, David, did you get that? Yeah, okay, looks like you're rocking and roll. What's the difference here? There's something obviously different in the script. What is it? And this is where I want you to actually jump into the script. Now, you can use this just the way I've created it, but really what I ideally want from you guys is I want you to make this your own. And what do I mean by that? You know, all of these you can see are hopefully exactly the same script, but different stuff is actually displayed on the screen. Now, how do we do that? The answer is, if you go into the script itself, you can actually tell the computer what you want plotted. And the way that we do that is all of the code is dumped into the script. And then, in essence, everything is coded to plot on the script. And the way that you display different indicators in the scoring mechanism is just by simply commenting out what you don't want to see. So you can see here, the very first study that we have is we have the 6 EMA, 13 EMA, 30 SMA, 200 SMA, like I said, our moving average studies. And you can see if I type in these little forward slashes in front of the plot, then that comments out that line of the code from the script. You can see I've written up here MAs. That's not part of the script. That's commented out, and it's just for my notes. And, you know, really good computer programmers will have tons and tons of notes in the code so that they can actually understand what it is that they've done. So as you can see here, you know, this study in particular, and we're looking at the 1.2, the signals themselves. Actually, you know what? No, before we get into that, I think I just want to show you just the index itself. So 1.1, this is the index itself. And so what is actually plotted here, right? The moving averages are commented out. Not only do we do a study of the moving averages, but remember from this screen, right? So this would be just showing the indicators themselves. But remember from like this screen, we can actually plot the actual indicator scores themselves. And so that's what, now where to go? That's what these plots are. In essence, we have a number of different sort of scoring mechanisms, right? And I just happen to call it MA bull, bull 1, bull 2, bull 3, but you can see micro is greater than the short term. If it is, then it gets a bullish reading of 1, else it gets a bullish or a bearish reading of 0. The short is greater than the medium-term moving average, same thing, 1 or 0. Short is greater than the long-term moving average, right? 1 or 0. Medium is greater than the long-term moving average, 1 or 0. So in essence, our moving average index is actually made up of 4 different studies, right? 1, 2, 3, 4. All these different studies go into making up the moving average index. Now, we can plot the individual scoring systems if we want. That's what this first line is, right? Hopefully everybody can see that. It's plotted in white. And then, you know, the medium-term moving average, the fast-term moving average. I don't actually have plotted on here. What am I missing here? I'm missing the short versus medium on here. We can add that in. It doesn't really matter. It's just, you know, these are all commented out, but you could very easily add this in here as well. And then, of course, what most importantly for the DI index is the moving average index, or in essence, adding all of these scores together, right? Some are going to be 1s, some are going to be 0s, and it ultimately gives us a moving average index. And then finally, you know, whether you plot the individual studies or, you know, and ultimately off of that original slide that I showed you, this had like all of the indicators individually plus the index itself all plotted on the same pane. You can do that. There's nothing wrong with that. And really, my hunch is you're probably not going to be doing that. But it's important that you understand how the mechanism of this works. And then, you know, as we go through, here's Willie. Same thing. We could plot the actual Willie indicator if we wanted to, but you can see that that's commented out. So if we go through all of these, you can see all of the actual indicators themselves and all of the scores. You can display them on your screen if you want, but they're all commented out. the code goes along and still calculates all the different, like here's OBV. And of course, here is the OBV indicator, and it's got both a bull bear bias, whether the index is above the moving average or below it, and it's also got whether it's above or below 0 to create an OBV index, et cetera, et cetera, et cetera. MFI with the moving averages. We also have an overbought, oversold reading here. And of course, like I said just a moment ago, we should have indexes that basically give us a cumulative reading of the MFI score, right? So there's MFI index, there's the bull bear battle line, there's the bias, stupidly oversold, stupidly overbought. And in essence, I like including the overbought, oversold readings in here because, as you can see, if the market's oversold, then we actually get a positive score. However, if the market's overbought, then that actually detracts from the score or subtracts from the score. And I think we also do that for Willie as well. Let's see, where's Willie? All right, so we have stupidly oversold gets a positive reading, whereas stupidly overbought gets a negative reading in the index score. So what are we actually seeing on the screen here? Well, if we zoom down to the bottom of this cumulative script, we have the DI. Here is the DI index. It's made up of the moving average index, of the Willie index, of the MACD index, of the OBV index, MFI index, and a accumulation distribution index. And in essence, I create moving averages off of the index as well. And you'll notice that, gee whiz, this is the only thing on the entire script that is not commented out. Can you see how there's no forward slashes off of these plots? The index, the exponential moving average, and the simple moving average. It's the only thing that's displayed out of this whole script. And so as a result, when you look at the script, this is the only thing that's displayed on your screen. Does that make sense? Where's Sheila? Sheila, are you around? You're my sort of guinea pig. Have I explained this in simplest terms? I don't know whether she's even still here or not, but I hope she is. Joji's typing in. What do you think, Joji? Did I explain that fairly well? Does it make sense what you're seeing here? Oh, here comes Sheila. Here she comes. All right, cool. Now, that's the indicator itself. And hopefully you notice that the 2.1, in essence, is just simply a scoring mechanism. All right, that makes sense. Well, so that's interesting. So PBV, I actually think that might be a typo, you know. So let's see, where are you? PBV. I got a hunch that should be OBV, but let's go take a look. So OBV plot. Look at that. Can you see how this line here? And it's great that you caught that. That's awesome. It's not plotted here, but can everybody see? And I don't know whether you can see because the screen's kind of small. But in essence, that variable is not correct, right? That variable should be OBV out, not PBV out. So really what you're saying there is that's a typo. And, you know, I don't know whether you guys remember, but I would say I used to subscribe. So if anything, Joji, what I think you should do is go and change that PBV to OBV. And then see if you can, you know, uncomment everything out and see if you still get that error. And if anything, that's kind of cool. Like I said just a moment ago, I used to subscribe to a newsletter, and the guy would say in the newsletter, well, we actually put the typos there on purpose because there are some people that actually all they do is they just hunt for typos, and it sort of gives them a great sort of joy if they can find a typo. Anyway, the point of the matter here is that basically is an error in the code. And, you know, when you do write these scripts, and it's not really fair to you guys that error exists, but if anything, it's good that you caught that now. But in essence, it shouldn't make any difference to the actual index score because you notice that was just the plot of the OBV, but when you actually do the OBV index, it's OBV bull bear, and OBV bull bear is measuring OBV out and OBV out too. So it actually wouldn't make a difference in the overall score and the reporting of the DI, but it would make a huge difference if you wanted to actually see that plot. So Joji, and great job that you found that. It's important when you're writing code to be able to recognize that. Does it make sense, number one, why the error was reported? And then number two, when you change that to OBV as opposed to PBV, does it work now? I actually haven't done that uncomment everything out function before. I've never seen that. But great job that you found that. That's excellent. And everybody should be aware of that. And if anything, it'll just make sure that you're paying attention. So Joji, can you just tell me whether it ran with you making that small alteration? Hopefully it did. Sheila is typing up an essay here. What's on your mind, Sheila? I'm here. Chat not working well, though. All right, and Joji says running now. Excellent. So if anything, kind of a fun little curveball there, and hopefully I walk through how to fix that curveball. And good eye, Joji. +1 for you. Okay, so the point of the matter here is that this is the index itself. Now let's talk a little bit about the signaling system. So hopefully you've added everything to your chart. All you got to do is go click show code. And now it flips over to the 1.21. And so now what are we displaying on the screen? So if we go through our script, everything's commented out. Should be interesting to see if that OBV typo is still in there. OBV, look at it is. Oh, wow. So you're going to have to go in if you want to make sure that your code is perfectly awesome. Go in and change that P to an O. And I'm not even quite sure how that P got in there, but nonetheless, there it is. So I've gone and made that change and saved it. So now when I load this up in the future, it should say OBV there. But you can see all of that's commented out anyway. So what is it that we're actually showing? And down at the bottom here, I've included in this script DI signals, right? So this is the only thing that's different, is that I've just basically created a small script that's going to, in essence, you can see DI fast by equals DI index is greater than DI index E, right? And it'll get a 1. Slow by, the exponential moving average is greater than this slow moving average, and it gets a 1, else it gets a 0. And then fast sell, right? That's the index minus the exponential moving average, or not minus, but is greater than or less than, gets a 1 or a 0. And the slow signal is the exponential moving average is less than the slow signal, gets a 1. And remember, this is a sell, so it's going to be the exact opposite of the buy. In essence, hopefully what you see here is I have commented out the fast signals, but I've left plotted the slow signals. So there is the DI slow buy, right? That's this line, all right, 158. That's what this line is. And I've colored that yellow. And then 164, I plotted the slow cells, which is line 160 on the code, and that's in red. So what ends up happening here is it just spits out a very mechanical. Thank you, Joji. Appreciate that. It just spits out a very just simple flip back and forth. Now, do you necessarily need to have both lines? Not really. You could just have the yellow one just going on its own, either 1 or 0. I kind of like this the way that it does here because you can clearly see the transitions back and forth. That's entirely up to you. We could just very easily comment out this slow signal. So I've made the change. I want it to be reflected on my screen because you can see as I typed in there, nothing changed. So how do I get the script to actually reflect that change? All I got to do is hit save. So I hit save. And now you can see we just have the the fast buy signals. Excuse me. I think this is slow buy signals, right? Yeah, slow buy signals. Right? And it's just plotted on there. I like to do both because then that way it gives me a nice clear visual of clearly the bears taking over, the bulls taking over, etc. You can see this switch back and forth, but it's not critical. Okay, so hopefully everybody understands the mechanics of how this script works. And now I want to sort of show it to you in action. It's interesting when I first actually developed this script, you can see, like if we zoom out, this is 2015. So I actually first built this script on PineScript back at the end of 2014, the beginning of 2015. And this was basically the first sort of module that I taught people. If we look at 3 different time frames for those signals, and what does that sort of look like? Here is sort of an updated version right here. I have on here, this is the hourly study. I have on here the 4-hour study, and I have on here the daily study. Hopefully you can see the daily study does not change that much, right? We went into bull mode, ironically enough, off of the dailies, way down here at about 3,400. And using the 3 thumbs signals, what you're going to do is you're going to go on your lower time frame charts, and I would recommend that you create like an icon for 4 hours and an icon for the dailies, and then I use the arrows for the hourly signals. So what we ideally want to do here is we want to just simply have, when all 3 signals are pointing in the same direction, you act. So what does that sort of look like, right? Here's a really, I mean, just a fantastic example of this in action. So this event right here is basically that, you know, the daily turn, right? Which comes in right there, right? You can see where I have the D mark. And you'll also notice that on that event, and actually I need to zoom this out a bit. On that event right there, also notice that the 4-hour also turned on that event. Right there, right there. Can you see? I know, and people are going to be like, man, you should do this full screen, blah, blah, blah. But I want to make sure that the chat box is in here so I can see if you have any questions and, you know, feedback from you guys. But can you guys see? And actually, you know what we'll do is, why don't we just sort of maximize? Can you see that the 4-hour turned bullish there? The daily turned bullish right there. So in essence, the daily turned up. The 4-hour was still waffling here. But in essence, there's where the daily turned up. And if we sort of overlay that, that would be right there. See that? Right there. And at the same time, where are we here? That the daily turned up right here, right? That would be right there. The 4-hour was bullish, but and the 1-hour was bullish. But I don't think it's not a good idea to take a trade based on the daily signal if these are already bullish. And as you can sort of see, I've marked on the chart where the daily turn is on my hourly. But notice that on the event that the daily chart turned here, maybe we'll move this over a bit so you can see that, right? So that's right in, yeah, right there. Notice that the 4-hour actually turned bearish right on that daily turn event. See how it's bearish right through here? And at the same time too, right, the hourly chart, while it was still bullish through that daily signal, the hourly chart actually turned down through here. So the way that I want you thinking about this is, let's say you're a bull, is you're going to wait for the dailies to turn up. And you remember in recent daily briefs, we had Julian come on and he said, well, the daily charts turned up. So as a result, I can't really hunt shorts. And frankly speaking, I'd have to agree with him. It's not a bad idea that if you have your daily signaling up, that you really don't hunt shorts because you're going to be fighting against the tide, if you will. So the daily turned up, like we said, over here. But then the 4-hour and the 4-hour was already up, right on that event. So there's no new signal from the 4-hour. And the hourly chart was already up, so there was no signal there. And then notice we actually rolled over to bear on the 4-hour on this event. And also on the hourlies, we rolled over to bear. We quickly flashed a very quick 4-hour buy right here. But notice that the hourly had already turned up. So what we want to do is we want to see the daily signal come in. Then we want to see the 4-hour signal come in. And then finally, we want to see the hourly signal come in. So what does that sort of look like? So we wait. Okay, so we're getting some humming and hawing. Ooh, 4-hour turned up, but the hourly had already turned up. So then we wait some more, and oh crap, 4-hour turned back down. And the daily is, the hourly is waffling here. It turned back up on the hourlies, but notice that the 4-hour was still down. Now we have a situation, and I've highlighted here, where the daily is up, the 4-hour just turned up. So now when we get an hourly signal, we've got the 3 thumbs situation. Does that make sense what I just said there, guys? Super important that you get this concept. So we're going to wait for the daily signal to come in, then wait for a 4-hour signal to come in, and then finally, once these two have turned up, the next hourly signal that we get, we act. And of course, being up. Does that make sense, guys? Somebody give me some feedback here. Have I confused the hell out of you, or does this make sense? Sin says it makes sense. I hope, or maybe yes, it makes me confused. All right, makes sense, yes. Okay, good, excellent. Okay, so the point here is, holy shit, what a signal. Do you see how just by waiting, yes, the daily signal was over here, but then as we said, the 4 hours and the 1 hours were kind of waffling. But just by waiting for all of these signals to all correspond, it got you in and woohoo, price just took off like a rocket. Yeah, start at a higher time frame, wait for the highest time frame to signal, then start working down and wait for your 4-hour or whatever your sort of medium term signal is. As soon as that agrees with the higher time frame, then go down to your lowest time frame, and literally on that mark, and really what I would recommend is you let the lowest time frame signal come in, and then literally you want to take the next trade that spits up 1 tick higher than whatever this bar that generated the hourly signal you want to try and get in. So let this hourly signal come in. Doink, it's in there. Beep. Next candle prints. And, it's entirely up to your own discretion whether you just buy the clothesline level. And you can see in that candle, you got lots of time to get in there. You could work an open order at that clothesline level. Or in this case, and it's entirely up to you, but in this case, I basically just placed the order right at the clothesline level. And you can see this candle, it moved around enough. You can't say you couldn't have gotten a fill. And in fact, even on this candle, you could have gotten a fill off of that level. Or if you want, you can place your buy on stop order right on a tick higher than that candle high. And so beep, you would have been filled right there. Regardless, in essence, you want to wait for that hourly signal to come in. And then the next bar, you want, of course, wait for this to confirm and close. You certainly don't want to front run this. You have to let the candle finish. But the next candle, that's when you get in. And like I said, I mean, this was a really cute example because the market just took off like a rocket here. Boom! Now, how you ultimately close these trade ideas, that's entirely up to you. What a timely example for this. Yeah, well, the cool part about it is that basically I just went back and just said, okay, well, let's go look at the last two signals. So the last two signals takes us all the way back to basically the end of the year. So in essence, here we are the middle of February. Basically, that's the past 2 months price action. And what did they look like? And so in essence, that's what this image is. Whoops, not that image. Isn't that weird? Oh, I must have hit that wrong button. There we go. Let's put that there. And then we'll go like that. There we go. So this was the past 2 months data. And in essence, hopefully you can see the 4-hour turned down here, but the daily was still pointing up, so there wasn't a trade. The 4-hour was down, the daily turned down here, and now the hourly turns down here, which creates a short trade. So the algo, in essence, wants to go short here. Now, where you ultimately end up covering your trade is entirely up to you. In this particular case, I've just simply demonstrated that I'm going to cover the trade when the hourly turns back up. And so in this case, yeah, the market did go all the way down here, but the hourly turned up on this candle right here. So you would have walked away from this trade right here. But 1.44 risk reward, not terrible. Also, too, the question is going to be, where are you going to work your stops? In this particular case, what I would recommend you do is just simply identify market structure. So on this particular case, I just said I'm going to place my stop above this wick. And if the market reverses and heads back up, I'll just walk out. You could also just get stopped out on a reverse signal here on the hourlies. That's fine. Or you could just simply say, look, there is that candle that produced the sell, right? That's this candle right here, doink. Beep. The next candle opens up. You're short from the signal level. You can place your stop just above this signaling bars candle. And if this thing just quickly reverses and it's a head fake move, you get stopped out. No big deal. So you didn't necessarily have to risk this entire candle, but I just wanted to show you for illustration's sake that quite often what ends up happening is all of the signals, now all of the time frames are all pointing in one direction, and you just want to go with that push. So a really good example. So as we're sort of working through time, you have to understand, guys, you're never, ever going to build an algo that's 100% right all the time. It just doesn't happen. In this particular case, we had 8 signals, 5 were winners, 3 were losers, which in essence is sort of in that neighborhood, right? 5 divided by 8, 62.5%. We're in that sort of 60-70% area. And really the question at the end of the day is your average winner bigger than your average loser? And you can see within the wins, we actually had some pretty big wins. This one was like a 3.82 risk reward. In essence, that same sort of logic that I talked about just a moment ago. You just take the signal off of the candle. And in this particular case, I said that I'd risk against these lows, but you could have just risked against the signaling candle's low. And in that case, it would have given you one hell of a trade, because you notice the signaling candle's low, it never went back below there. So as sort of a fun sort of assignment for you, I'd like for you to sort of experiment with, do I use market structure, this previous low, to risk against, or do I just take this signaling candle's range? I'll enter on a break of the top of the range of that signaling candle and have my stop just below. It should be an interesting experiment, guys, if you really want to play with this and work with this. Now, let's show you a couple of the losers, right? Because you're not going to win every time in this game. It's just as simple as that. So in this particular case, we had the dailies in the 4 hours, right? You can see where the hell are we here? The daily and the 4 hour turned up here, but I don't know whether you remember Thomas. He was getting all pissed off because we were getting a whole bunch of fake sort of signals through all this. So here's a good example where the hourly turned up here. And in this particular case, I just simply said, well, look, you can see where the lows are. You can see the signaling candles level. So beep, we go long. What we're really looking for is that big pop right out of the gate. But in this case, you can see it floundered, 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 floundered. Now, just putting this together, I don't know whether this market actually moved up first and then came down. If it did, you might have actually just sort of walked away at a nice profit there. And if we had our stop just below the signaling candles low, right in there, would we have actually gotten our fill? You can see it's just about 2-to-1 risk reward. You think that's a coincidence, right? There's 2-to-1 right there. That's exactly where this candle stopped. Now, if this candle opened up and went up first and hit that 2-to-1 before dumping, well, maybe you might have gone, well, Brian, it hit 2-to-1, so I took profits. But nonetheless, I'm going to consider this a loser in that the market didn't have any major traction heading higher, came down and really stopped you out, busted the low of this price structure and the low of the signaling candle, and it's a loser. And hopefully you can see, relatively small. Now, you might have looked at this and been really pissed off. Oh, those fuckers stopped me out, and then they brought the market right back, bastards. That happens. But remember, we're not here to be emotional about this. Here's another example. I don't know how this candle actually went, but, the dailies, as we said earlier, the dailies in the 4 hours, they turned up where? Over here, right? Daily 4 hour turned up there. So we're still hunting longs. Now, did this candle, you can see there is the hourly signal, beep, right? So next bar, you're hunting longs. Did this candle actually go up first, all the way up here, and then dump down? I don't know. But I suppose you could argue, well, fuck, Brian. I mean, I took this long off the signal, and it spat up like a 4-to-1 risk reward, so I took profits. Well, cool, awesome. But for the purposes of this conversation, I assume that this is a loser. And boom, you're stopped out. No big deal. Shit happens. Next bus in 10 minutes. The problem here, of course, for us humans is that you had to book 2 losers in a row, and now you start going, oh, okay, well, I don't know whether I really want to be doing this anymore. And look at that shiny object over there. I want to, go and do something else, whatever. And, of course, Murphy's Law, you miss that trade, you start losing focus, and the next one comes along, and, of course, it just goes straight up. All right, so do you guys see how this sort of concept works? Does anybody have any questions about how I come up with this logic? When all 3 cross either bullish or bearish, you would get a signal. The lowest time frame would be the last to cross. Well, and really what we want, David, is we want to make sure that the dailies are pointing in the direction. then well, and it's up to you, David. I mean, you could do like a 5-minute, 15-minute, and 1 hour, right? And be trading off of like 5-minute charts. But the point is, it's highest time frame tell you the direction. Then medium time frame points in the same direction, and then you're waiting for that third time frame, and when that third time frame kicks in, you just literally go with the signal. Does that answer your question, David? I think it does. I hope it does. Okay, Dennis says, correcting my comment above, the signal could be reduced to one alert that fires when the 1 hour turns bullish if the 4 hour and the 1 day were already bullish and the 4 hour had turned bullish after the 1 day. Yep, sounds good, Dennis. That'll work. And the great part about it is you guys are computer programmers. Remember, I'm not a computer programmer. So this was actually pretty damn tough for good old Brian to create. You guys are looking at this going, man, I can do this in my sleep. All right, what do you think? Have I given you a fun little tool to play with here? Do you think you can go out and create some kick-ass scripts to go and own this market? I sure hope so, because this is an incredibly powerful tool. And then, that's right, the lowest time frame is absolutely your trigger mechanism for the trade, David. Absolutely. Excellent. Now, as I had said, I first started running this algo system back in like 2014, 2015. This was a situation where we had 15 trades where 11 were winners and 4 were losers. Pretty damn good odds, eh? I just happened to just throw this study together for you, which was just literally what's happened here over the past 2 daily signals. One bearish signal on the dailies, and how are you going to trade that? And then one bullish signal off the dailies, and how are you going to trade that? What I really need for you to see, and this is sort of big picture kind of conversation. Do you see that what ends up happening with these signals is that the signals are actually generated at the very ends of moves? Does that make sense? You've heard Brian talking lots about wait for the consolidation, right? And we could even argue to a certain degree that you could draw things like, manually. Oh, God, that Beamish guy wants us trading manually again. But hopefully you guys can see the bullish bots that are setting up here. And, I suppose this would be like taking this scripting to like the next level. But, if we just look at this little signal unto itself, do you see how really what the DI does, and especially if you use like that 3 thumbs kind of methodology, what it really does is it gets you focusing in, right, on taking trades at the end of consolidations. Now, this one's probably not the best one because the bot entry level is way down here. But in essence, there is where all the 3 thumbs all agreed and told you to go long. Do you see how this ends up happening? You get like initial burst that sends the higher time frames bullish, and then slowly but surely, if we wait for all 3 time frames to correspond, it forces you to wait for this consolidation to finish to set up the trade. Does that make sense? And it works really, really well. I mean, if anything, using the 3 thumbs, it forces you to slow down. So what hopefully you see is that repeatedly these signals come in right at the end of consolidations. Can you see that? Isn't that fucking cool? I mean, when I saw this happen, I was like, damn, stone cold. Like, look at where this signal comes in. I mean, literally textbook. Now, like I said before, sometimes you're going to get failed trades. It happens, right? This was a short one. that ended up turning out into a bull one. So you have to, and this is where you have to let the computer just do its thing. This one was an interesting consolidation, right? But sometimes you get these consolidations that spit out signals, and it turns out that it's a fail. The bottom line here was what should end up happening is if you build a big, robust data set that ideally we want to make sure our winners outnumber our losers, and we want to make sure that our average win is bigger than our average loss. And that's what we're looking for. Remember, guys, you're never going to be right 100% of the time. Lose that need to be right 100% of the time. And as we said earlier, the reason why algos do as well as they do is that if the trade idea doesn't work, then they close out the position and there's no ego hurt. Computer doesn't care. You booked a loss, move on to the next one. Okay, we're approaching 2-hour mark, so I think I've sort of said my piece here. The most important thing for you to do now over the next week is get out there and play with this tool. My biggest motivation, coming out of today is I just want to simply give you the very basic shell of the script. And really, I don't mind sharing it with you. Obviously, don't go and just copy this outright and then call it your own. I will call you out on that. But what I would prefer to see happen with all of you guys is I would actually like for you to get in there and play with the various different tools. Maybe you're a fan of RSI, so maybe take out Willy and plug in RSI into your model. The logic of adding or taking out indicators that are in this script is very straightforward. Maybe remove all of these indicators and only do it off of like moving averages. We had one really cool adaptation of the script last quarter. geez, it was about a year ago, where the kids took everything out and just did this off of RSI. And then we're just hunting for overbought and oversold readings on RSI, which is perfectly fine. DAV, I don't know whether any of you guys are DAV people. All the current level oneers are all DAV people. DAV took out everything here and just simply asked, show me W's in OBV and Willy, and create a script around that. Perfectly fine. The point here is I want you to put your own personal spin on this. Make it your own. And then just go and have some fun with this, because it's a lot of fun. And you guys are like such kick-ass computer programmers. You probably could actually, improve on this. It wouldn't surprise me at all. How do you use 1.11? What do you mean by use? I don't understand what that question is. That's a pretty broad question, Zban. Well, I sure hope I helped Dav. He's an interesting character, that's for sure. Do you want to expand on that question, Zban? What do you mean, how do you use 1.1? I don't understand what the question is. How does 1.11 relate to 1.21? Well, I don't know whether you can see this or not, but in essence, 1.21, maybe what I'll do is I'll minimize that. 1.21 is just simply, you see how this crosses over from red, bearish, to yellow, bullish? So really all that is just the moving average crosses, and maybe you can't see it because it's red. Let's change the color. If I make that like teal, maybe you can see it a little better. So in essence, that's not much better either. In essence, this signaling system is nothing more than the moving average crossing back above the other moving average. They explained it before me. Okay. Does that help, Z-Band? Do you see? Right here, it was bullish because it was above the moving average. Then it came back down below the moving average. So it's bullish, yellow, and then it switched to bearish, red. You see how the two relate to each other? Maybe I should put this away. So bearish, right? And I don't know whether you heard this earlier. Maybe you need to go watch the video again. They're exactly the same scripts. It's just what's commented out and what's not. For the 1.11, the actual index itself and the moving averages are plotted. For the 1.21, it's exactly the same script. It's just that the signaling system is plotted, but the index itself is not. Yeah, I mean, it's exactly the same script. It's just what's plotted. Okay, the last thing I'm going to mention to you is there are services like this CQG where you can actually set up accounts to actually trade these algo systems. You guys have probably heard about 3 commas. There's also another service called AutoView. So you can actually create interfaces that will actually execute these trade signals. And we could, that's sort of like send script, where, if you get 3 thumbs all pointing in the same direction, it will, in fact, probably not a bad idea for Send to maybe throw it on the site. And then we'll have like his Davos script. It actually sends out like emails and stuff to that effect. And maybe PM him. And if you are interested, we can get that up and running on the site, which I think would be totally cool. But the point that I'm trying to make here is that we have a gentleman who's, I think, in the level 1, and actually his business partner is in this level 2 program. So I'm sure he's watching this right now, or maybe later. They are working on a sort of mini course that we will offer, sort of dovetailed to this course, this module in particular, to actually set up the computer to actually engineer the trades on its own based on these signals. So that skill set is a little bit beyond me. So I've actually asked them, because they are extremely computer savvy and they know how to interface and how to build scripts to interface with trading platforms to actually execute trades off of these signals. So I've asked them to actually put together 3 or 4 module little mini course that will teach you how to take these signals that something like the DI generates and actually execute trades off of them. So if you are interested in that service, Reza, you probably heard me talk about him in the daily briefs. He is working feverishly on that program and that little mini course for you guys. I think it would be an excellent dovetail to this, where you can basically set up scripts to generate signals. And like I just showed you, the 3 thumb signal is totally awesome. And then, follow their instructions on how to get this signal, which I'll give you and the script will give you, to actually engineer the signals. Dennis says, has anyone already tried setting this up to trade automatically in the past? Not this one in particular, but keep in mind, Reza and his whole crew have basically built scripts that are, in essence, almost exactly like this, and they're trading away as it is right now. I don't know whether they use the DI in particular, but Rez has told me that basically it's the same logic. They use Willy, they use MACD, they use moving averages to come up with a cumulative reading, and then execute the trade-off of multiple time frames. So in essence, it's the same logic, and they're just running this as we speak right now. My hunch is that maybe what I've sort of talked about today, and like I said, part of their group actually has some people that are in the program right now. So my hunch is Andrew will probably take this back to the team, and maybe they might do some fine tuning on their current algo. But I will say that there was a missing piece. Like, I traded this manually, and it works great manually. But to actually set it up so that the algo is operating on itself is, we actually call it, for RITE, we call it going the last mile. There's sort of that, there's a hole. How do you get to actually implementing this CGQ kind of program? And this is one example. There's a bunch of other different programs. And RITE, I think, like I said, they use AutoView. They use 3 commas, all that kind of stuff. How do we get the computer to actually take the signals on its own? And I've actually asked them to specifically build out that product for you guys, because I think it would be an awesome dovetail to this module. Okay, I think we'll leave the class at that today. You know, every technician is different, so it's incredibly important to make this your own. I really want you to put your own personal stamp on this particular script. You can use mine if you want. And if you want to say, you know, this DI indicator off of 3 time frames, just the shit, absolutely love it. Great signals. Okay, I'm okay with that. But I really would like you to take the time over the next couple of weeks to really put your own personal stamp on the script. That's why I gave you the raw code. And you can go in and play with it and make all sorts of fun tools. As always, right, do I have 3 unrelated studies suggesting a particular trade location? You know, these are all just basic rule of thumb. Great part about DI is technically it's like, if you use the 3 thumbs method, it's like 45 signals. Are my profit objectives realistic considering the risk taken? You know, I don't think it's a good idea to use these algos and shoot for like 100x on your trades. I think that's asking a bit much. I have found in general, you know, good old 2-to-1 risk reward. If you can get anything north of 2-to-1 on a consistent basis, then if you're running, you know, even 60% accurate, you're making a lot of money. The DI cumulative is a measure of both volume and momentum, and really volume and price momentum. I always keep forgetting that word there. It's kind of weird. So in essence, it works awesome for me if I'm going to use the DI cumulative as sort of my excuse me, my indicator proxy. I don't know where that cough came from. So, you know, if you want to, you can use the DI as your indicator tool coming into location, looking for indicator confirmation, then finally give me some structure to work with. Great. You can use the DI, the 3 thumbs method, to force yourself to wait for those bulletproof setups. The point here is that this tool is very flexible. And it produces some absolutely great signals. So go and have fun with it. Show me your own personal flair that you can put on this. Maybe there's a particular indicator that you really like that we can add to the code. And if it produces even better signals, I'm all ears. Right? I'm more than happy to both give you credit for it and also incorporate it into the program. This is a very simple application of building scripts and algorithms, and hopefully it's giving you lots to think about here. Okay, so why don't we leave it at that? I hope you've enjoyed this tutorial. You've got some fun tools to go off and play with. It is well past the top of the hour, so why don't we leave it at that? Have yourselves an awesome rest of your day, evening, morning, wherever you are in the world. All the best. And the only thing left for good old Brian to say is a big bye for now.